Today's show was super fun. I had the opportunity to connect with my good friend Sherman Ragland, who, as you just heard, will be emceeing the Think Realty Atlanta event, which is coming up September 22nd, 23rd in Buckhead at the Westin Buckhead. Awesome location. It's going to be a great crowd. And Greg, you'll be speaking there too, right? Do we?
I will be.
Do we have any gold nuggets that you want to share with us about your topics of discussion?
Sure. Yeah, we'll give them a little preview. I can't wait for it. I like to Think Realty events a lot. I go to a lot of conferences that are for mainly large Wall Street-backed institutional investors, and they're good guys and gals. I enjoy being with them. But my heart is with the entrepreneurs, and that's who Think Realty attracts, right? So the radio show, the events, the website, all the things you guys do are bringing aspirational investors to the table. And so when I come and you guys give me a slot to share some thoughts, I always try to see if the value I bring can do a combination of things. One, kind of give them the landscape of what's happening in the market that they can fit themselves into, where it isn't just always the same, right? Real estate investing, the marketplace changes all the time. The opportunities open and close all the time. And it's kind of my job to figure out where the opportunities are opening and then when they're going to close so that I can get my clients in and out. And so Atlanta is an awesome place to do this. And the overarching message that I'm going to bring to that audience of entrepreneurs is this concept that you and I have batted around before, which is the consolidation that's taking place in single family real estate. That this is an asset class that is as fragmented as can be, that sandwiched in between commercial real estate, apartment buildings, residential apartment buildings, and home ownership real estate, so single family homes that the people who live in them own them. Right in between those two asset classes is single family rental, which is single family homes that an investor owns and that a tenant lives in. And it's not been developed until just recently. It's been a mom and pop entrepreneurial, I'd call it an entrepreneurial playground, but it's kind of the Wild West. There really haven't been professional services. There haven't been websites dedicated. There have been things like this, a radio show, special events dedicated to teaching people how to do this, but that's all changed. Since 2012, 2011, on the heels of the housing crisis, a lot of new players came in that tried to, that succeeded in building massive national portfolios, 10, 20, 50, 80,000 unit portfolios of single family homes. And in working with them, the industry had to figure out how to master the data, how to analyze the markets, how to find the opportunities, and how to identify, buy, fix, rent out, and then manage thousands and thousands of houses. And so that gets real complicated, right? Anybody can juggle one ball. Can you juggle three? Then it's juggling. Can you juggle seven? It's a whole different animal. Can you juggle seven lit torches? Right now it's a totally,
right.
Or chainsaws, right?
That's right. Man, chainsaws, that's the worst.
That's the worst. Yeah, you can't make many mistakes.
No, you can't.
So that's the world that I've been in. And so what's happened is, the big players have done something that the smaller players have known for generations, which is single family homes are a beautiful investment. They're in demand, they generate income, they get more valuable over time. Every year, pretty much, they get a little bit more valuable, and it compounds. And so now, 6-7 years after the beginning of this trend, there are lots of very, 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 very big players that are entering the space, and all the big players have billions with a B, more dollars to work with to create large portfolios. And what it presents to the attendees at Think Realty events is it creates a food chain. Okay, so picture that graphic you see in your whole life of a little guppy, and behind that guppy is a bigger fish, but still little. And then a bigger fish, bigger fish, bigger fish, all the way to the other side of the food chain where there's a monster, and the monster's jaws are wide open, and it's eating everything. It's eating the fish in front of it, who's eating the fish in front of it, et cetera, et cetera. In this case, though, getting eaten in the food chain is a good thing, because what you're doing is you're recycling your capital. And there's so much room for everybody in the space to be able to be members of the food chain. For example, you can have a person sitting in the front row at Think Realty Atlanta who is going to buy one house. They're going to buy one house at the courthouse steps. They're going to buy one house in their neighborhood. They're going to fix that house. And by virtue of fixing it, they have added some value. And they're going to sell it to somebody else. And they're going to make some money. They're going to get paid because they added some value. The person who buys it might buy it, rent it out. Now they've turned it into an investment property if the person before them didn't. And they're going to add it to their portfolio of 9 properties. Now they have a portfolio of 10 rentals. and they can then sell it up the food chain to the fish behind them who has 90 properties. And this is going to put a cherry on top, make it 100 properties. Now they've got a 100-unit portfolio, and they want to keep building that till they have 200, because guess what they're going to do? They're going to sell it to the gal who's up one more level in the food chain, who's got 900 properties, who wants to get to 1,000. And then the big guys are there to buy the 1,000. And everybody along the line, if they fix the property, they add value. If they make it into a rental, they add value, they get paid. If they consolidate it with 10 or 50 or 90 more, they've added more value by creating aggregation benefit, okay? You can give an investor the ability to buy in one closing 100 houses. The big clients like that a lot. Believe me, those are our clients. They love the idea of buying 100 instead of one. And so what happens in a consolidation situation like that is that as long as you have the biggest fish down the end, it creates a current, all right? It creates momentum that other people can swim in, that can create value, recycle their capital. So you put out 100 grand, you scrap and save, and you do a flip or two, and you have 100 grand. You go, you buy a couple of properties, you roll them up, you recycle your capital. Now you have 125. You take that, you buy 125,000 worth, you get a loan, you buy 250 worth of houses, you roll those up. It gives you the velocity of capital, the ability to put it in, get it out, put it back in, get it back out again, grow it as you go, with the knowledge that there's always going to be a bigger fish in front of you, no matter how big you get.
That's right.
Like I know some of the guys and gals that are the second biggest fish in the food chain. They're huge. They have 5,000 houses. They're going to sell the whole 5,000 to the biggest fish down the end.
Yeah, it's interesting that you mentioned velocity of capital. I also like to think about it as velocity of house, right? The more aggressive we are with the pay down strategy, with debt on our properties, the quicker of the homes that we can buy, right? More house buys, more house faster. So imagine if you had 3 houses, the cash flow from all 3 houses are going to pay down one of those houses. And then you just redirect that cash flow so that house number 1 fully paid off, fully cash flowing. Then you do the same thing with house number 2, house number 3, house number 4. Over a 10 to 12 year period, even if you don't have 250 houses, guess what? That's okay. You'll have 12 to 15 to 16 homes, single-family rentals, fully paid off, generating, say, $700-800 a month in rent. Out of which, what's a safe expense ratio, Greg, on that? 20%?
Oh, 40%.
Let's say 40%, right? So double that.
You pay a third-party manager. That means you have no responsibility except for owning it and collecting the rent. Yeah. Exactly.
So let's take that and multiply that. Let's call it 50%, right? So $800 a month in rent. 50% of that goes away to expenses. That's $400 a month in rent times 12. You're looking at $4,800 a month in free cash flow. Easy.
That's life-changing.
Life-changing.
It happened before you woke up in the morning. It was coming in. So
that's right.
That leads to the whole overarching conversation, which is what I want people to understand, is that there are so many niche approaches, so many different kinds of strategies. People have no idea how creative investing in real estate can be. Too many people think investing in real estate equals buying half-price foreclosure and flipping it. That's all they think it is. And they don't realize that things like you just said, like I love the strategy of buying 10 houses, selling the first 5 and paying off the last 5 and being paid off on 5 houses at some point, in 18 or 20 years for just a regular family. These aren't tycoons, right? They're people that are going to work every day. They're doing right by their family, but along the way, they have this side hack of accumulating a portfolio. And back to the original point, the idea that when you have a portfolio, you now know there's a ready exit for that portfolio where you can sell it with the tenants in place to one buyer up the food chain. And that didn't exist a few years ago. Just a few years ago, people didn't have a place to sell that portfolio. So that's a big improvement.
That's right. And that's why OwnAmerica.com is created. So that works out really well. And you're connecting institutional with the guy or the gal that's building that portfolio.